Good evening, everybody. I think it's time to sort of have a close look at these stock markets. We've got a bit of a bounce going on at the moment. Again today, earlier on in the session, which seems to be just sort of giving up some of those gains as I speak. But stock market volatility has been extremely choppy in recent days. The market isn't quite convinced about where we want to be, where we're going. And that's sort of showing up in some of the price action. We have had a bit of a bounce, but if we look at some of the risks out there, we're looking at negative global growth outlook, and negative growth outlook is not particularly good for earnings or future earnings, and so therefore not great for stocks. We've got increased geopolitical risks at the moment. Obviously, the classics are the Russian situation in Ukraine, but I'm getting a bit of a concern over the sort of relationship fading between the US and China as well. China, with its new government that they've set up, really, under Xi, the new Politburo leaders seem to be a bit more insular, and also talking a lot about tensions with Taiwan. So, and also behind all of this, of course, we've got very stubborn inflation, which seems to be pretty unwilling to come down. These are things that have led to some pretty extreme bearish market positioning. The market got hit pretty hard. The fear index has been above 30 level for most of this month, to be honest, and that is a fear of uncertainty. We've been quite easily seeing 2 or 3% moves in equities up and down. I mean, markets are a bit like a lift at the moment, up and down almost randomly, that we're seeing. Particularly today, we had a very strong session earlier, giving back all those gains today. And this is classic of a market that's so very unsure of itself. So, stock markets are very fluid at present, and we need to understand really what's sort of driving those. So we've got, this nervousness that keeps, people are buying the dip, but they're not holding on to the trade for very long. And as soon as there's a bit of bad news, they're out again. So, you can see this USA 500 from the 11th of September, making a fresh year low and then bouncing quite reasonably, looking at Friday's close, up till Friday's close. But no one wants to be caught short of the lows, and this is one of the things that's happening. So we keep finding these dip buyers and taking the market back up. However, they seem to be running into people who are still prepared to sell to rally as well. So this is a very uncertain market. The trend is not clear. On the longer term, the trend is still down. But to be realistic, we're in a bit of a noisy session at the moment. And so I think there's going to be risks to sort of a buy and hold strategy. And even, selling the rally, you've got to get your timing right, check out your technicals. And I think the market is just throwing signals at me that the market is very uncertain about what it wants to do. There's a lot going on with Fed speakers. Now, this, as you can see, is not a picture anything like me. That is our Chris Ashton, but it poses a few questions. Is sentiment starting to turn? This rally that we've seen suggests people are hoping that there's a low in place. Which markets offer the best value? Is picking a base fraught with danger? It is, because there are still ongoing issues that have driven stocks down. So, for instance, central banks are still raising rates. Now, we may have peak inflation, but peak inflation is not 2%. We really need to define that. And until inflation is seen trending down and coming down quite quickly, then central banks, even though they may not hike 75 basis points every day and possibly do less, as indeed we saw from the Bank of Canada today, they are still hiking. And therefore, this has implications for yields, it has implications for stocks. So, one of the questions I get asked a lot is, will I know when the base is in? Probably not until it's well and truly established. So, it's a bit of luck and judgment, but if you believe that things have changed enough to suggest a base is on, you've almost got to be strong, put your stops in the right place, check your charts, and have faith in it. The problem is that you need to see things that are fundamentally changing to make that stock market reverse on a fundamental structure. So quite what we see is these bear market rallies, which are technically driven. The market gets overly short, they square up, and the market goes up again. So a recent survey by Bloomberg saw different investors suggesting it may be stocks that US stocks that lead the current slump. And that's probably right. I mean, these are the global benchmarks, for instance. I mean, US stocks lead everything, really, to be honest. And so I'm not surprised by this. The US are definitely better positioned than most to weather this storm. Commodities are priced in dollars, and so the dollar impact, the commodity impact, is not as great in the US. Their economy is stronger. They've got slowing growth, and obviously that slowing growth impacts some more than others. And the US is way and above stronger than everybody else's. Although recent data in the last few days is suggesting that these rate hikes are beginning to have an effect. So, but Europe and the UK look particularly weak, as you can see on this chart here on the left. Retail investors and professional investors, suggesting who will go into recession first. I think the new government in the UK is going to try and avert that, but I think it's a massive task to get that done. If we look at the European situation, we've got slowing growth, but the ECB is looking, the central bank is looking like they're going to start hiking rates even further. So 75 basis points priced for this week on Thursday, tomorrow. Bank of England's on the 3rd of Nov. They are also expected to raise rates 75 basis points. These are big moves. They are very big moves. And, we can see on the Germany 40 here, we saw that slide off down into the 3rd of October, and we've had a bit of a bounce since. But, if the ECB is hiking and they remain hawkish, and we have to remember one thing here is that these central banks are dealing with extremely low real yields. Real yields are nominal yields, so nominal interest rates minus inflation. And so this is a situation where these yields are still stimulating the economy. They have to take that back, and they have to take back some of the QE. So QT is going to be on the cards as well. That means they're going to be allowing bonds to fall back into the market that is already falling. So there's some real risks out there still, but at the moment we seem to have another pocket of support at the moment in stocks. But interest rates still look like they're going up to me. Certainly we're nowhere near a pause from some of these central banks. Even the Bank of Canada, who only did 50 today, said that they will be hiking further, just at a slower rate. So, we have to ask ourselves if really things have changed. And, to me, some of the inflation causing problems are central banks don't want inflation to stick around, as consumers will get used to higher prices. So it becomes embedded in the consumer psyche. If that happens, inflation gets much harder to deal with because we expect prices to go up and we address things accordingly. Now, if you look at this table on the right here, you can see the different countries where their inflation is. Now, I'm sorry, but in the EU, can 1.25% yields fight 10% inflation? I don't think it can. So they're looking to move rates to 2% this week. Is that enough to fight 10% inflation? Not sure it is. So how far will these moves go? Even in the US, we've got 3.25% interest rates, but we've still got 8% inflation. So it shows you that there's quite a bit of work still to be done by some of these central banks, particularly Australia's slowing, Canada's starting to slow. The market seems to think everybody else is going to slow. But look at this chart. There is a lot of work still to be done. So price pressures climb. We've got risks out there still. So higher interest rates remain a risk, and inflation is impacting global growth. The IMF put out some stuff earlier in the week. You can see this on the chart on the right. Their growth outlook has been cut sharply since the start of 2022, and this lot are relatively conservative. But these are big numbers. So if we're going to have a slowdown in global growth, many multinational companies are going to struggle with their margins with high input prices and a lack of demand. So, we've got, some of these firms have done better. I mean, with the higher yields, the banks have done quite well. Bank of America, tops estimates. We saw JP Morgan, Citibank, but the big retailers, the big bellwether companies like Caterpillar, FedEx, Apple, Microsoft, their earnings are starting to come in pretty weak. We've got Twitter tonight, so we'll keep an eye on that as well. Is their advertising revenue as strong as it was? So profit margins are at risk. Earnings expectations are being marked lower. And so this is why we get some of the beats in the expectations, because expectations are very low. So, Q earnings so far have been slightly better than expected. That's because of who has reported so far. I think some of the shocks or some of the damage, like we saw last night after the close with Microsoft Google and another is what could be on the cards going forwards. So still quite a lot of risks out there with earnings, and these third quarter earnings could have a nasty impact on stocks going forward. So the final word for me really is that we've got there many challenges ahead for stock markets, but cash is still sitting on the sidelines. We've seen an awful lot of money come out of stock markets and go into cash. So with that cash on the sidelines, some strategists think the bad news is priced. Now that's interesting, because this is maybe why the VIX, the fear index, isn't as high as many people thought it would be on this sell-off. Maybe early on, some of the bigger players did manage to hedge, and therefore, the big sell-off, the big capitulation has not been seen and may not be. So it's really interesting where we are at the moment. I think we're at a bit of a crossroads, but we do get some strong up days. So far, these have been bear market rallies, but there is a danger that we do start to form a base. But for that, I think we need to see things like unemployment start to rise. The Fed has targeted unemployment. The tightness in the labor market is something they keep telling us about. And as long as that tightness remains, I think they'll keep hiking, because they realize the economy is still quite strong. It's difficult to have a recession when you've got a tight labor market. So we need to see if this data starts to move. Some of the data is moving and weakening quite substantially in the housing data, consumer confidence, PMI data, but expectations are still for the Fed to hike 75 basis points on the 2nd of November. And traders want to know what comes next. So, we are at the sort of a crossroads at the moment. It's too early to tell whether central bank meetings in the next days will be, well, they'll be eagerly watched, but it's too early to know what they're going to do. They are not giving us much forward guidance. They do say that data matters. They are data dependent. And we've got the ECB tomorrow. We've got Bank of Japan on Friday, another big one, RBA 1st of Nov, and the Fed on the 2nd of Nov, and the Bank of England on the 3rd of November. So a lot coming up. So just prepare yourself for that. It's going to be an interesting week or two, and markets are going to be moving.